with just one class. Understand? Yes. So just maybe you just need to create like 1 hour 30 minutes, or maybe 1 hour 20 minutes to be able to watch some of those particular small topics. So I want us to look on this topic, financial instrument, and basically I've said this is something you covered in financial reporting and analysis. So the first thing we need to ask ourselves here, what are financial instruments? Financial instruments generally, this refers to the various securities which are issued by the company whenever the company wants to raise capital. Like then what we know is that if a company wants to raise a capital, the company may decide to issue shares. The company may decide to issue things like debentures, things like what? Like bonds. So those securities which are issued by the company to raise capital, generally this now what referred as a financial instrument. But what is the definition of a financial instrument in accordance with IFRS 9? IFRS 9 defines a financial instrument as any contract which is entered into by the company and basically give rise to a financial asset, one of the company within that contract, and also give rise to a financial liability or equity to the other company. So let me repeat that. I've said a financial instrument is a contract which is entered into basically between two or more companies, and it gives rise to a financial asset, one of the company, a financial liability or equity to another good, to another company. So therefore, financial instrument we are saying is a contract which give rise to financial asset one entity, and a financial liability or equity, to another entity, or basically to the other entity, That is the definition of a financial instrument. For us to be able to understand this particular definition here, let's take a very small example. We assume we have a company here, company X, and this company wants to raise capital. So how can this company raise capital? This company can raise capital either by issuing shares. This company may decide to issue ordinary shares, or this particular company may decide to raise capital by, for example, issuing debentures, or basically issuing bonds. And therefore, we equally assume here that some of the shares, or basically some of the debentures or bonds issued by company X, they have been issued to company Y. So in this case, we say that these two companies, to pay interest, and once the debentures mature, the company has to redeem them by paying back the principal amount. So this financial obligation to pay interest, to pay the principal amount, this is a form of a liability, and specifically this is known as a financial liability. So therefore, if you're told a company issued debentures, issued bonds, then that is a form of a financial liability. So therefore, this company, you can see, once it has issued debentures, then that will give rise to a financial liability as far as that company is concerned. We have said if this company issue ordinary shares, our company will raise ordinary share capital, and basically that gives rise to equity. And then in this case, equally, we assume that these shares, or basically debentures issued by company Y, some of them have been issued to company X. So once this company buys shares, because this company would be buying, this company would be investing in shares, will be investing in debentures issued by company X. So if you invest in shares, if you invest in debentures, to you, that investment is an asset. That investment is what? Is an asset. And specifically, an investment in shares or an investment in debentures, including treasury bills, treasury bonds issued by the government, that asset, we refer to it as a financial asset. Remember from what you did in financial accounting, financial reporting, there are different types of assets. We have property, plant, and equipment, which are tangible and current assets. We have intangible assets, and we also have financial assets. Financial asset is an investment in shares or an investment in debentures. So our company here, company Y, will invest in shares or debentures issued by company X. So therefore, to this company, that is a financial asset. Is a financial good asset. So therefore, you can see in this particular contract, which is entered into between two companies, company X and company Y, it basically gives rise to a financial asset to this company, equity or financial liability as far as this company is concerned. So that's why we are saying a financial instrument is a contract which gives rise to financial asset, one of the company, a financial liability or equity to another word, a company. That's why in our introduction we said financial instruments are those securities, including shares, including debentures, which are issued by the company. Today's word, capital. Now, in this topic here, generally, we're going to look on how we do what, how we account for the financial assets, the financial liabilities, and also the classification, because we have different classification of financial assets, different classification of what, of the financial liabilities. But even before we do that, next I want us to look on something called the recognition of financial instrument. Recognition of financial instrument. What do we mean by recognizing financial instrument? Recognizing, in very simple terms, is basically the process of recording something like an asset or recording something like a liability in the company's books of account. So a question arises here: if this company issues shares or issue debentures, or maybe this company purchase shares or debentures, so when should these companies go ahead and recognize, or in other terms, record those particular shares or debentures in their books of account? According to IFRS 9, this started here, financial instrument, whether issued or basically whether purchased, should be recognized once an entity becomes a party to the contractual relationship. What does that mean? It basically means that once this company has issued these particular shares or debentures, even if our company has not been paid for the shares, has not received cash for the shares or debentures which have been issued, our company has already become a party to that contract simply because it has already issued the shares or debentures. The same case, once this company purchased the shares or debentures issued by this company, even if this company has not paid for those shares or debentures, this company should go ahead and recognize that in its books of account as a financial asset. So therefore, according to IFRS 9, a financial instrument should be recognized in the company's books of account whenever an entity becomes a party to the contractual relationship. Then next, I want us to discuss something to do with the recognition of financial instruments. The recognition basically is the direct opposite of recognizing. The recognition is the direct opposite of what? Recognizing. The recognition of financial instruments. So the name of the ministry. This is the Ministry of 𝐻𝐶. And this is what? This is a statement of financial. This is a statement of financial what? Performance. Statement of financial performance, which is basically for the year which ended 30th of June 2025. 30th of June 2025. So that will be our title here. And basically, what do we start here with? What do we start by recording? We start by recording the revenue. The revenue of this particular ministry. Remember, revenue, we have said that, like the incomes. But basically here we don't use the word income. Incomes, we use the word incomes when dealing with the profit-making organizations. But when dealing with the non-profit making organizations, basically we talk of what? Revenue. We talk of revenue. So which items of revenue do we have here? First of all, the first item we have the transfer from the exchequer. Transfer from the exchequer, this is the amount of money which was allocated to this ministry from who? From the exchequer, or basically from the treasury. So remember here we just need to have a we can have two columns, maybe. Let's just have two columns. We have two columns here. And I hope you can see our figures up there. They are given in million of shillings. So we have the transfer from the exchequer. In other terms, I've referred to this as budgetary appropriation. This is basically the money which was allocated to this ministry from who? From the exchequer, or basically from the treasury. The transfer from the exchequer, that is 750. So below that, what do we have? We have the fees and licenses. So basically what I've said is that if you go to this ministry basically provides some services. It charges a small fee. So this is the fees, which basically is what is charged. And also what fees charged for the services offered. Fees and what? Licenses. That is still an item of revenue. So below that, we have liabilities for long-term benefits. Liabilities for long-term benefits, this is a non-current liability. We have the long-term borrowing, a non-current liability. Finance cost is an expense, is an expenditure. Then from there, we have the supplies and consumables used. I've said these are those items which are used in the office, like the stationaries and so on. That is an expenditure. Wages and salaries, an expenditure. Other operating, actually, we have other expenses. Other expenses, that is an expense. We have the transfer from other ministries. That is still a revenue. A transfer from other what? From other ministries. From other ministries. How much is that? Transfer from other ministries. I hope you can see that figure. Can you see that figure, Lydia? 𝐎𝐍𝐋𝐈𝐍𝐄, 𝐎𝐍𝐋𝐈𝐍𝐄, can you see that figure? 𝐻𝐹A, can you see that figure? Transfer from other ministries. Is it 75? Yes, it is 75. Then we have transfer to other. Transfer to other ministries is an expenditure. Then we have computer equipment and software. Those are what? Assets. Yes. And then we have motor vehicles, added buildings. All those are basically assets. And then we have the revenue from exchange transaction. Revenue from the exchange transaction. So the revenue from the exchange transaction. Yes, let's continue. So basically, I've said that this basically transfer from exchange transaction is also what? Is also a revenue from what? From the exchange, from exchange transactions. From exchange transactions, how much is that? That is 150 million. That is 150 million. Then from there we have other revenue. So other revenue, so we also capture that here. Other revenue. Other revenue is an amount of how much? Is an amount of 900. Is an amount of 900. Then from there we have payables. Payables, what is this? Who can tell us what is a payable? From this category, what we have covered, we have covered in other topics. Payable is what? Radian. 𝐎𝐍𝐋𝐈𝐍𝐄, 𝐻𝐹A. What is the a payable? A payable is what? A payable is what? I'm told by 𝐻𝐹A is part of the creditors. Felix. Kezia, these are an expense. Kezia, this one is an expense. Hapana, this one is not an expense. Payable is a liability. Payable is a liability, is not an expense. Sasa, yes. In other terms, this is what we refer to as creditors in other topics. Sasa, Kezia, remember that. So reserves, this one will go to the statement of financial position. Cash and cash equivalent is an asset. Receivables is an asset. Inventory on consumables. Anytime you come across inventory, this is a current asset. Is a current what? Asset. So basically, you can see we don't have any other item of revenue. So what we need to do, we get the total revenue. We get the total revenue. So that we move and we less what? The expenditures. But before we less the expenditures, give me the total assets. Not the total asset, the total revenue. Give me the total revenue here. The total revenue. The total revenue, I'm given by Kezia a figure of 56. 56.25. 56.25. 56.25. 56.25. Confirmed by Jeffa? Yes. So then we need to proceed and realize what? Expenditures. Expenditures, we have a number of them. I think we will start from where we have our first expenditure up there in those balances. The first expenditure we have should be the finance cost. Should be the finance cost. Should be the finance cost. And basically we record now the expenditures in the first column here. And that is an amount of 150. 150. Then we have what? We have the supplies and consumables used. The supplies and consumables used. So the supplies and consumables used, this one is an amount of 600. It's still an expenditure. So below that we have wages and salaries. Wages and who? And salaries. Wages and salaries, which is an amount of 1,500. So below that we have other expenses. Other expenses. Other expenses. So the other expenses is an amount of 1,800. 1,800, yes. So then from there we have transfer from other ministries. Remember that one was an income here or was a revenue. And then below that we have transfer to other. So this money transfer to other ministries. That one is considered to be an expenditure to our ministry here. Transfer to other ministries. Transfer to other ministries, how much is that? That is an amount of 750. Is that correct? The transfer to other ministries, is it transfer to other ministries? That one should be 750, yeah? Is that the position? 750? Jeff, is it 750? Yes. So below that we have basically computer, motor vehicle, land, all those are assets. Revenue from exchange, we have already considered that here as an income. Then we have other revenue, payable, reserves, accumulated fund, cash, reserve. Yes. So in our case, we don't have any other item of expenditure. So let's get to the total expenditures here. And basically we take that to the last column. We less that from our total revenue. We less that from our total revenue. You can see how simple this was because you just need to know what are incomes, what are revenues, what are expenditures. So this will give us a total of 48. We less it from that, and automatically in our case here, we will have a surplus. We will have a surplus for the year. 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 So the surplus for the year will be how much? The difference between those two values there. The surplus for the year, I'm told, is an amount of how much? The surplus for the year, I'm told here by Jeffa, is an amount of 825. 825. kezia has also confirmed that. I hope you're getting the same Zido. I hope you're getting the same Meridian. Are you getting the same figure? Are you getting the same figure? Felix, are you getting the same figure? HP. Ni nani anajiita HP? Who is this? Is this Doris mwenye anajiita HP ama ni nani huyu? Yes, HP. Are you getting the same HP? Okay, sawa. That is confirmed. Yes. So basically, this is now what was required as far as that question is concerned. And basically, the marks allocated there were 5. So automatically, what is marked here are the items of revenue and the items of expenses. Oh, these Doris. Okay. So that basically what was required. So I want us to move now to the other part of that question. You can see how simple this is. Roman 2, the statement of financial position. Statement of a financial position as at 30th of June 2025. Yes, at 30th of June 2025. 30th of June 2025. Now, basically, I've said we prepare this one based on the accounting equation. We start by recording assets. We classify them into two, and then we less liability. So here we start by recording assets. And specifically, we start by recording the non-current assets. And I hope you can be able to recall, we say that the non-current assets, these are basically the assets which are expected to be used by an entity for a period beyond one financial year. Number two, these particular assets, they are acquired basically to help an entity in terms of doing what? In terms of generating income. In terms of generating what? Incomes or basically revenue. So therefore, those are the assets we start by recording here. So we have a number of non-current assets. We have a number of non-current assets. So which non-current asset do we have in our case here? So which non-current asset do we have here? I think we can start from where we have computer equipment and software. Can we go to where we have computer equipment and software? Can you see that, Doris? Computer equipment and software. Equipment and software. I hope you can be able to see that. Yes. So that basically is an amount of 400. 400. So below that, we have motor vehicles. We have motor vehicles. Motor vehicles having a value of 350. Then below that, we also have land and buildings. Land and buildings. Land and buildings. So for the land and buildings, that is an amount of 5250. 5250, yes. So do we have any other non-current assets? Do we have any other long-term assets? I can't see any other. I can't see any other. I can't see any other. So what we need to do here is, first of all, we get the total. We get the total, so that then we proceed and record current asset. So this will give us a total of what? This will give us a total of what? This 7 and 9. Are you getting 59? The total non-current assets. Total non-current assets. Therefore, Felix, are you getting 59? Are you getting 59? 59, are you getting 59 here? 6,000. Oh, sorry, 6,000. Yeah, this one should be 6,000. 6,000. Then we proceed. We record the current assets. Now, for the current assets, we have this current number of them. Current assets, maybe you can start from where we have the first non-current assets is basically we have all of them below those balances. We can start from where we have the cash and cash equivalents, cash and cash equivalent, cash and cash equivalent. And maybe someone may ask here, what is cash? Cash refers to any money which is held in the bank account, including cash in hand. And the cash equivalent is our short-term investment. For example, if you have invested in things like what? The treasury bills, which are short-term, that is part of the cash equivalent. Or maybe you have invested in shares trading in the securities exchange market. That is not cash, but is a cash equivalent. You can be able to sell those shares within a very short period of time. So that is basically 750. So below that, we have receivables. Receivables, still this one is a current asset, and that is 300. And then we have inventory. Inventory for what? For consumables. Inventory for consumables is basically an amount of what? Is an amount of 150. All those are current assets. All those are current what? Assets. Do we have any other item of current assets? Any other item of current asset? Any other item of current asset? I can't see any. I can't see any. So what we need to do is basically we get the total current. Okay, in this case, I think we can just go ahead and let's get the total current asset first of all. Total current asset, this and this will come to 900, and that will give us 12. And then from there, we get the total assets. So how do we get the total assets? To get the total asset, we add the total non-current asset plus the total current asset. We add this and this. Total non-current asset and total current assets. I hope here you're getting 12. Are you getting 12? Yes, that is confirmed. So the total assets in our case will be what? Will be 72. And actually, we can denote this using capital A. Our total asset will be capital A. And then from there, I've said, when preparing this statement of financial position for public sector entities, we proceed and we less the liabilities. So to this, we proceed and we record what? The liabilities. We record the liabilities. We record the liabilities. These liabilities, we classify them into two. Non-current liabilities and what? And the current liabilities. Non-current liabilities and current what? Liabilities. Non-current liabilities and current liabilities. Non-current liabilities and current what? Liabilities. Non-current liabilities are the long-term liabilities. And I think we have two basically up there. The first item is transfer from exchequer fees and licenses. And then below that, we have liabilities for long-term benefits. That is an non-current liability. We have liabilities for what? For long-term benefits. For long-term what? Benefits, which is basically how much? 300. And then below that, we have long-term. We have long-term borrowing. So the long-term borrowing is an amount of how much? Is an amount of 1,500. So those are non-current liabilities. Do you have any other non-current liabilities? And I hope if you check on this particular question, you can see similar items are given together. I don't know whether you are seeing that pattern, because if you check, for example, these current assets, they were given together. The non-current liabilities were given together. If, for example, it is like expenses, they are given together. Yes, mostly if you check, you'll be able to see we don't have any other non-current liability. Maybe you can just go through the other items. So below that, we have finance costs, suppliers, wages, other expenses, transfer, computer, motor vehicle, land, revenue, other revenue, payable, reserves, accumulated fund, cash. You can see we don't have any other. So basically what we need to do here, let's get the total. The total. So this one would be 1,800. 18 what? 1,800. And then from there, we proceed and we record what? We record the current liabilities. So the current liabilities, I think in our case, we have, I think I've only seen one. The one, or basically the payable, that is. Other than payable, do we have anything else? I can't see any other. I think we only have one, and that is basically what? Payables. Payables. Who can see that amount? How much is that? The amount for payables? Kezia. And remember, you say that this one is a liability, not an expenditure. Kezia, I hope you can remember that. How much is that amount? Kezia, give us that amount. Give us that amount. Yes, I'm told by Kezia, this one will be 750. This one will be 750. Yes. And then what we need to do, because we only have one, we don't need to get the total current liabilities. We can proceed and we get the total liabilities. We get the total what? Liabilities. Total liabilities will be this plus this. And that basically will give us 2550. Will give us 2550. 25 what? 50 will give us 2550. 25 what? 50. So having that, then we proceed and we get something called the net assets. Net assets. And in fact, we can denote this using capital B. Total liabilities to be our capital B. So how do we compute the net assets? The net asset, this one is equal to total assets, whatever you have here, minus liabilities, minus total liabilities, what we have there. Net asset is equal to asset minus what? Liabilities. So we take 72 minus 2550. 72 minus 2550. That one will give us what? Doris. Will give us how much? Will give us how much? Will give us how much? 𝐍𝐷 will give us how much? Will give us how much? That one. It will give us 4650. So basically double underline search. We double underline search. So after double underline search, we finally record what? Equity. So basically I've said equity. This comprises of accumulated fund, which must be adjusted with the surplus or the deficit for the year, plus the reserves. Plus what? The reserves. So the first item we record here is basically the accumulated fund. The accumulated fund. The accumulated fund, which we have there, which basically are given in those balances. I hope you can see accumulated fund is somewhere down there, below inventory, above receivables, and also above cash and cash equivalent. So accumulated fund is given as what? As 1125. That is the accumulated fund at what? At the start. So to this accumulated fund, we need to add the surplus for the year. We add the surplus. But remember, in this case, if, for example, we had a deficit, that one should be deducted. So we add the surplus for the year, and that is 825. So that now will give us the accumulated fund at the end. So this will be how much? So 0, 5, 9. That will give us 1950. Are you getting 1950? Are you getting 1950? The accumulated fund plus the surplus for the year, 1950. Yes, that is confirmed by 0. And finally, I'll say to this, we also add what? We also add the reserves. We also add the reserves. Now, we have reserves still above this accumulated fund, and the reserves is an amount of 27. And the reserves is an amount of what? 27. So we get now the total equity. And this basically equity is another name for net asset. Equity is another name for what? For net asset, simply because we know that from the accounting equation, we say asset are equal to equity plus what? Plus liabilities. So equity. So if, for example, or we make equity the subject of the formula, you can see equity is equal to assets minus what? Liabilities. And actually, we are saying the difference between asset and liabilities, this one is also known as the net asset. So if you take asset minus liabilities, that can be known as net asset. It can also be known as equity. So, yes. So equity is the same with what? The net asset. So the same case here. This total equity is the same with the net what? Assets. Is the same with the net asset. So we add these two values here, which will give us 46 what? 4650. 4650. So, and basically we have said whatever you get here as our net asset, this one, that should always agree with that one. And I hope you can see that is the case. So this is basically what was required there. And equally the marks allocated here were 5 marks. Or 5 what? 5 marks. So the payable was still outstanding, and the balance payable was still what? Outstanding. Now in that case, we have two adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us first of all we deal with we compute the amount of unreleased profit, amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. On inventory. Remember, unrealized profit we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. By Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Lock. The unsold goods would be half of the goods which were sold by Paper to Lock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1/5. So this one will be, the margin will be 1/5. So how much will be our unrealized profit here? So it will be half to 50, and basically that will be 50 million. So this unrealized profit number one, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number two, this one will also be deducted from the retained earnings of the selling company. The selling company is Paper. That one will be deducted from the retained earnings of Paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. Those are the three adjustments which will be made as far as that and this profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000. 500 million, that is, because the amount of money which Lock Limited was supposed to pay Paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. group receivables, and group payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically revealed that both goodwill on acquisition and on paper limited and the interest in CISA were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no awarding which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill on acquisition of this company, that is paper, paper limited, and as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in 2 forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and lock limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end 1st or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what? Here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary.